The Reserve Bank of India, RBI, has announced a significant $10 billion forex swap to manage liquidity and stabilize the rupee. But what does this mean? How does it impact the Indian economy, the banking system, and your finances? Let's break it down simply. Forex swap is a temporary exchange of currencies between the RBI and banks. Here's how it works. The RBI will buy US dollars from banks in exchange for Indian rupees, injecting rupee liquidity into the banking system. After a specified period, banks will repurchase the same amount of dollars from the RBI along with the swap premium. Key takeaways. RBI injects rupee liquidity now by purchasing dollars. Later, it absorbs rupee liquidity when banks repurchase the dollars. This mechanism helps prevent sudden currency fluctuations and liquidity shortages in the banking system. Why is RBI doing this? The RBI's move addresses two main concerns, preventing a liquidity crisis and stabilizing the rupee. Recent liquidity issues. As of 20th February 2025, India's banking system faced a liquidity deficit of approximately 1.7 trillion rupees. Factors such as government cash outflows, including GST payments, and forex market interventions have drained liquidity. Rupee volatility can impact inflation and foreign investor confidence. Important facts. In January 2025, the RBI conducted a $5.1 billion forex swap to infuse liquidity. India's forex reserves stood at $644.39 billion as of 20th December 2024, down from a peak of $704.89 billion in late September 2024. Let's explore how this move affects the Indian economy and you. Positive effects. Increased liquidity. Banks will have more rupees to lend, boosting credit availability. Stable interest rates. Enhanced liquidity helps maintain stable borrowing costs. Investor confidence. Economic stability can bolster stock markets and attract investments. Risks and concerns. Temporary measure. This action provides short-term relief and doesn't address underlying liquidity issues. Inflation potential. Excess liquidity might lead to higher inflation if not managed carefully. Currency fluctuations. Persistent rupee weakness may necessitate further interventions. The $10 billion swap is part of a series of measures by the RBI to manage liquidity. Other RBI measures. Open market operations. OMOs purchasing government securities to inject liquidity. Variable rate repo, VRR, auctions, providing short-term funds to banks. Previous forex swaps, conducting swaps, including a $5.1 billion operation in January 2025. These initiatives aim to stabilize the economy. Their effectiveness will depend on global market trends and inflation management. The RBI's $10 billion swap is a strategic move to manage liquidity and stabilize the rupee. Its success will hinge on global economic conditions and domestic policy responses. Like this video if you found it informative. Comment your thoughts. Will the RBI strategy be effective? Subscribe for more financial insights.